Welcome. Good afternoon. Thank you for joining us. It's always nice to see attendees start to come on in. Good afternoon and welcome to Conscious Capital Market Alert Call. With everything going on in the markets lately, we're here to help you cut through the noise. My name, for those of you that don't know me, is Heather Desjardins. I'm the Chief Experience Officer here at Conscious Capital, and I'll be your guide through today's session. Before we begin, I want to take a moment to acknowledge that this is a private and distraction-free space. Your video and audio are off, and your participation is anonymous. Today's webinar will run for 45 minutes. We'll hear from Lawrence Ford, Gregory Berry, and Brian Huckstep. After that, we're going to open the floor up for Q&A session, and you'll have the opportunity to engage with the gentleman today. Feel free to submit your questions through the webinar, and we will address them during the last session of today's call. So many of us are familiar with Zoom, but just as a reminder to submit your questions, you can locate the toolbar at the bottom of your Zoom screen, and you will see a Q&A button to submit your questions and or comments. Before we start, we've had a long tradition here at Conscious Capital, and that is to start our gatherings with a 30-second moment of silence to ground ourselves and set the intention for our time together today. Let's begin. Fantastic. Now let's dive in. So we're going to hear from three individuals today. First will be Brian Huckstep. He is the Chief Investment Officer and co-founder of Advise on Investment Management, where he manages a team of investment professionals and traders. Brian's has 33 years of industry experience, and before Advise on, Brian spent 17 years as a senior portfolio manager and head of U.S. asset allocation at Morningstar. He holds a CFA and a CFP designations. Gregory Berry will be representing the voice of our clients and friends on this call who could not join us today during today's Q&A section. Greg runs our Boulder, Colorado office and supports clients in expressing their values through investing. Greg advocates for people with an evolutionary worldview and contributes to investment philosophy and strategic partnership. And finally, it's my pleasure to introduce Lawrence Ford. Lawrence is the CEO of Conscious Capital Wealth Management and the chairman and founder of Conscious Capital Foundation and Future Capital. A visionary leader often referred to as a shaman of Wall Street, he has dedicated his career to bridging the worlds of finance, purpose, and impact. He now leads the AI Alpha SMA Fund, applying cutting-edge AI investment strategies while staying true to his mission of aligning capital with the advancements of human consciousness. Lawrence brings decades of expertise in wealth management, purpose-driven investing, and global impact initiatives. And we're honored to have him here today to share his insights. Lawrence, you wouldn't mind stepping forward? And I'll have
Thank you, Heather. Thank you very much. And thank you, everybody, out of these busy little hectic days to take some time out of your precious day and join us. I am going to be very brief and just introduce the purpose of this call. You've heard that Brian is here on the call with us, who is a wonderful partner of ours, and we are very fortunate to have him on this call and as a partner. And Greg, as you heard, will be facilitating questions, which really is the lively part of this, and Brian will go through a formal presentation first. The purpose of us doing this call now before our quarterly call is probably very obvious to all of you. There are a lot of fluctuations in the market, and there are a lot of issues going on a geopolitical perspective, as well as aspects that are really happening from more of a historic point of view, with changes in empires, as our Ray Dalio will always talk about, changes of power globally, as well as, not to be missed, the evolution of artificial intelligence, which is doubling in its power every 3.4 months. So we got a lot going on, and we are very proud to be representing you. We do not take it lightly. We have seen some of this coming and provided options for alternatives for our clients, and will continue to And you'll always hear throughout this call, everybody is different. So please reach out to your individual advisor for specific advice going forward. And now I will hand it off to Brian. Brian, take it away.
Oh, Brian, you are on mute. There you go. Okay.
Thank you. Thank you, Heather and Lawrence, both. And I'm very, very happy to be here today. We've been working with Conscious Capital for over a year at Advizon, and it's been a terrific relationship. Everything they do, we're impressed with. They've always got advisors and investors, first, in thought and, do the right thing. So, we love to have partners like that. So I am going to share my screen. I have roughly 20 slides put together today. And I'm going to talk about what's been going on in markets. I'm going to talk about where we see markets going and, give some comments around that. So when I speak, it's always to advisors. So I keep my comments a little bit more advanced than what I would do if I were speaking with individual investors. But my goal is always to help give you tools to speak with your clients. So I know, quarter just ended, 9 days ago, and you're probably have meetings scheduled with clients, regularly scheduled quarterly meetings. You're going to talk about returns through quarter end. So I'll talk about those quarter end returns, but I will also talk about the last 9 days. So it's been a very, very, volatile period for securities over the last 9 days. And so I didn't feel like it was appropriate to only talk about quarter end. So I wanted to talk about what's been going on for, that short period. So I put these slides together yesterday. So the returns that you're seeing on the right-hand side, these are the returns I typically cover for our clients. And so I include Q1 2025, and then I go with a little more history for context. And I talk about what happened in Q1. That's my typical cadence. But for today, I've prepared for you some additional columns. So the market saw a terrific run up in prices for stocks and bonds for the first 6 or 7 weeks of the year. Stocks hit a peak on February 19. The S&P 500 hit 6,144 was its closing price. That was the highest it had ever been. And since that date, it has pulled back sharply. So we'll talk about that, what's driving that, so that you can help put that in context to your investors. And we definitely want to appreciate that investors do get nervous. They seem to remember those high points in their accounts a lot more than they remember the low points. And so, I think some advice I got when I was early in my career was to definitely talk with your clients a lot more when markets are down than when markets are up. So I'm going to highlight some of these things and talk about what's driving them. So I want to make a point. These 3 columns on the left, I've got year to date in that second column, the negative 13.6% for the S&P 500. And then I broke that down into the drawdown period. The through market close on Monday was 17.5. And then the first 6 weeks, which were up for pretty much every asset class we follow. So these asset classes are broken down into US stocks on the first 5 rows, non-US stocks on the next 2, and then bonds on the bottom 6. And so, the first thing a lot of clients talk about or want to talk about during these meetings is, how was the quarter? Tell me what happened with my statement. I see I'm down. And what you're going to find is a mix. Growth stocks were down 10%. Value stocks were actually up. So if you've got some of your clients that, I spent 17 years at Morningstar. I still have a load of Morningstar stock that's highly appreciated in a taxable account. That account is up. I'm happy. Through quarter end. So when I got my quarter end statement, I had made a couple dollars. But all my other investments were down. My small stocks were down. My growth was down. My mid caps were down. So we need to be kind of cognizant who we're talking to sometimes, because it is interesting. Some people don't realize through quarter end, value stocks were actually up, and non-US was up. I think a lot of people have seen that turnaround. So when we look at I think a lot of us have seen, and especially in the last 4 years, calendar years, international stocks have been very disappointing with their returns relative to US. International stocks have done fine. When we look at a 10-year or 3-year period, the returns are positive. but they've been way behind US stocks. Now, after this most recent pullback, a little bit of that has reversed. So when we look at non-US stocks, half of what drove the underperformance, especially over the last 4 years, was currency, and half was just really strong US stock performance that non-US companies couldn't match. Well, those both unwound in first quarter. So, valuations are a big driver. So I was surprised at this, how well non-US did. But when we decompose it into currency and stock returns, it's about half and half. So non-US stocks over the last 4 years had been getting relatively cheaper and cheaper and cheaper and cheaper every year versus US stocks. And there's always a limit to that. Small caps are going through that right now. Small caps, were down 9.5% last quarter. But relative to US, they're kind of keeping up. But for the last 4 years, that same thing had been going on. They've been trailing large caps for a while. So that's one reason I'm excited about small caps. But I'm going to keep going on, what happened last quarter, just so we can talk about that. And then we can talk about where we think that we're going on our team. So non-US stocks did well. It was emerging and international, half because of currency, half because of the stock prices bouncing back. Bonds did great. These bond returns were terrific. So when we look at those bond returns, high yield was up 1%, long bonds were up. So the riskier bonds in general tend to outperform the safer bonds. Now, the bar cap ag for most people, and that's this intermediate bond, this 2.8. If you've got retirees, you have bond allocations. This 2.8 is typically the most relevant index to look at. And these are really healthy returns, and I like to decompose that 2.8 into coupon and price. That way I can really understand what was going on and kind of understand if it's going to repeat. So this 2.8 was a strong return for the quarter. If we take this times 4 for a year, you're talking about 11% returns for a year. So these were abnormally strong returns, except for high yield. High yield pulled back a little bit. It didn't keep up with other bond types because high yields have a lot of credit exposure. And I'm going to talk about that in a few slides about that high yield credit spread and where we think that might be going. But suffice it to say, all of these bond categories did really well. And intermediate bonds, they're paying roughly 4.5 of a coupon right now. So in a quarter, our investors got coupons of 1%. And then the prevailing yield on 10-year notes dropped, and they dropped from 4.57 to 4.25. So that's a 33 basis point drop. And what happens when bond yields drop is their prices go up for fixed coupon bonds. And you multiply that by the duration. So I'm an economist by training. I get really nerdy about these asset classes, but like I say, I like to decompose that because it helps me predict what's going to happen going forward. These bonds enjoyed a 1.8% price bump on top of the 1% coupon because yields went down 33 basis points. So if they've got a 6 duration, 6 times 33 basis points is about 1.8%. So exactly what the market would predict, this 2.8 return. Now, what do we expect maybe going forward? It's probably just the coupon price. You don't expect, I think the 10-year and the average intermediate term bond, it's been bouncing around in the range from 4 to 5. For the most recent period. And I think that's a very neutral, fair rate. So until the next emergency arises where the Fed needs to raise rates to combat inflation or lower rates to buoy the market, I think we're going to stay in that 4 to 4.5 rate range. And we can talk about tariffs. We're going to in a little while. If we think tariffs are going to extend and what the Fed might do there. But I don't expect this 2.8 to continue. I expect more like a 1% each quarter, which is the normal long run average. Over 30 years, intermediate bonds return about 4.5 for a year, so about 1.1 per quarter. So these were outsized returns. It is notable, long bonds did well, so that's something we haven't seen for a while. Long bonds had a long period where they underperformed. Between 2008 and just recently, long bonds were returning not much more than short-term bonds and had just way lower returns than you would expect. When we look at the 10-year column, long bonds are underperforming intermediate by 0.5%. And I think that's starting to reverse. So I'm thrilled to see that long bonds are finally doing what they typically do in the long run, which is outperform in our portfolios. And I'll talk about this in a while also, the tilts we have incorporated in our advised on portfolios, but we added long-term bonds back into portfolios toward the end of last year. So I'm thrilled we did that when we saw the yield curve was upward sloping and that long bonds were paying higher coupons than short and intermediate. we added them back, and we're seeing that payoff now. So I expect that to continue. Tips are one. I'm going to talk a lot about tips in a couple slides, so I'll skip that. But they had a really nice quarter. I think people are starting maybe to expect, just on the margin, expect that tariffs may cause inflation, and so these tips get a little more attractive. So this isn't a huge outperformance, but it's there, and it's something I think worth commenting about, because I'm going to revisit that in a couple slides. Now, if we jump, and I had circled. Okay. So if we jump into the most recent year-to-date period and we address that for our clients, because a lot of them, they might look back and say, oh, my account, hit $1 million on Feb 19. It was Feb 19 that the S&P 500 hit its all-time peak. And so, we had a 4.6% year-to-date return at that point, just after Valentine's Day. And every asset class in this list of common asset classes that our team follows, they were all doing great. Everything was humming along, swimmingly until tariffs were announced. And then things changed. Everything changed. That's the major driver of what's been going on. And so since then, the S&P pulled back 17, 18%. Growth stocks pulled back a lot. So I want to address these one at a time. Why did growth stocks pull back more than value? Growth stocks were expensive to start the year already. I think we all know artificial intelligence related stocks, very exciting. We expect earnings to increase for a lot of these companies that work in that industry. But, when valuations go up, sometimes they get stretched a little far. And when you look at price to earning multiples for some of those tech related securities, they were a little bit rich. And so when the market, gets scared and is concerned about earnings, anything with a stretched valuation or just a high PE multiple is going to come down more. It's always been that way. And that's why value has held up better than growth here during this pullback period. It's not a huge delta. We've seen a lot more in the past than that. And once you go out to even a 1-year history or a 3-year, growth is still outperforming. But some of your investors who are big fans of growth may notice that it has crossed over into bear market territory. And for most economists, a bear market is when an investment is down more than 20%. A correction is 10% down. A bear is 20. So some of these growth stocks did cross into bear territory. But we just have to zoom out and look and see that gosh, even over 3 years annualized, they're still doing great. 10 years are doing great. So these pullbacks often are temporary. And, you're going to have to expect these once in a while when you have the outsized returns. So, I hate to say it, this phrase, but it is what it is. The high beta things pull back more in a downturn. Mid cap and small cap are down also. So I've been a little surprised by the small caps. When tariffs kick in, and I have a slide on tariffs later here, but they tend to impact small caps less strongly. And the idea there with a lot of economists is that large cap stocks do a lot of work globally. They're importing foreign parts in their goods. They're selling things abroad. And those large companies who do a lot of importing, exporting, whether it's the final good or a component part, they're the ones that are really going to see their earnings get damaged by tariffs. They're going to see demand drop. They're going to see earnings go down. But smaller caps tend to do more localized production, producing in the U.S., selling in the U.S. So I have been really surprised by this -20. I think that's an overreaction and a little bit of throwing the baby out with the bathwater, that it might be overdone. So we've become a little more constructive on small caps after this pullback. Non-U.S. stocks pulled back also. And here again, they didn't pull back as much as the U.S., most likely because those valuations were so much lower to start with. It's just like with value stocks. The definition of a value stock for most people is a cheap stock, a stock with a low price to earnings multiple. So if your stock is already inexpensive, as long as it's not going to go into bankruptcy, it tends to go down less in a drawdown. And that's what these international stocks have done. So it's not the case that, Europe is doing something wonderfully different. Their stocks were just so inexpensive to start with that, they can't go down that much anyway. So this is another one that I think might be a mistake. So I'll talk about this later. I keep saying that, but our portfolios are slightly underweight international, which year to date has been the wrong move because international has outperformed. But we're sticking with that. We're still concerned that tariffs are going to impact foreign countries more strongly than the U.S. And the idea there is, the U.S. imports, I think, roughly $120 trillion and exports half of that. So because we import so much, when those tariffs go on, reciprocal tariffs, follow, and then we're placing tariffs on those imports. When they go down, if everything gets cut in half, the foreign producers are hurt twice as badly because we import so much more today. So, we think that there's still a lot of damage to come potentially with earnings to foreign stocks if the tariffs stay on. That, we're underweight international, and we're not gonna add back to it anytime soon until we see something really, really change. On the bond side, during the pullback, it's been a mixed story. High yield is down. Like I said, with the quarter to date, high yield has a lot of equity-like characteristics. So when stocks go down, high yield credit spreads go up, which means their prices are coming down. People are concerned that some companies might go bankrupt, which is a valid concern. I have a good friend from college who is a high-level executive at a candle and perfume maker. They have a lot of stores in malls. I won't name the exact company, but he kind of explained to me, we were at a basketball game a couple weeks ago, and I said, Tom, how bad could it really be, with these tariffs? And he walked me through some of the numbers. He said, Brian, we make perfume in US. We then export it to Canada on a train, and it's going to get tariffed. They take that perfume and they put it into candles. They then send it on another train back to the US. And he's like, we're going to get double hit here. So, then I you take a look at some of the numbers, and some of the companies that don't have, huge earnings margins, when they get hit, some of those can be kind of bad. So, this is a concern with the high yield that we could see defaults jump up, and not for every company, but just for companies with tight margins, that some companies can't afford even a little bit of pullback. They could go out of business, and we could see bankruptcies. So, in our portfolios, on March 10 of this year, just 4 weeks ago, we cut our high yield in half, and we added tips to our portfolios. We expect inflation from tariffs. So I'll talk more about tariffs, but I'm glad we cut back that high yield. That was fortuitous of us. We got kind of lucky with our timing there, but cutting that back, was good. The reason that the high yield went down is because there is a concern about bankruptcies for some companies. Now, long bonds and intermediate and tips. So these bonds have done well, especially the government ones, because it's a safe place. If our clients come to us and say, boy, I'm really, really concerned, I really want to take some money out of the market, typically we put it in bonds. Treasury bonds in particular are backed by the government and should not default. Even if the government needs to print money, you're still going to get your money back. So they're positive even during these periods. So this is diversification doing its job. On our team, we manage 60 different portfolios. The majority are asset allocation models. I have been asked over and over and over the last 5 or 6 or 7 years about, boy, international hasn't done well, and bonds had a lot of down years. Why are we still having those in portfolios? And the answer has always been, well, there will come a time, it's diversification. And so these bonds are doing their job. They're adding ballast to the portfolios. We should remind clients who are not 100% stock invested that these bonds are doing their job. They're holding steady, they're holding up. The coupons are coming in, and we've had a little price appreciation also, while there's been a lot of demand for these bonds. And then, just the ordinal ranking, where intermediate did better than short, did better than cash. That's a function of the yield curve being upward sloping. We expect that to continue. So, next slide. So tariffs. I do get some questions from advisors about tariffs. And so I just wanted to spend a couple minutes. Some people are going to remember Econ 101, 102, and they're going to be able to explain this. But sometimes our clients come to us and say, explain to me what this is. Why? Why would the president do this? He says that it's going to be beneficial to the economy. Clearly, the stock market today is disagreeing, it looks like. So, I am a fan of tariffs in some cases, and that's not relevant for what we're doing with stocks today, but I understand why you would want to add some tariffs. The U.S. government has been spending a lot more than it brings in taxes. Our federal deficit of $36 trillion was on just an untenable pace of growth. And so taking some action, any action, bringing in revenue and cutting spending. So, cutting spending, the administration has been doing through DOGE. And whether you agree or disagree with how they did it, I applaud the idea that they're cutting the deficit by cutting some spending. I also like the idea of increasing tax revenue through tariffs. Maybe not how I would do it, but I love the idea that we're closing that gap and we're improving in the long run the deficit problem, because the debt eventually is going to be a problem that we're going to have a hard time covering the interest payments. So for me, just in the first place, tariffs are a great way to increase revenue. And also bring some production back to the US. So I like to go back to supply and demand. My formal training is an economist, so I always come back to this. So if the demand curve is red, and as prices go up, people demand less, and the supply curve is blue, what a tariff is, it's a shift. It's a straight up shift in the supply curve when prices go up. It's not the case that companies are supplying more, it's just that prices went up by the value of the tariff. So, if we're putting a 24% tariff on Japan, that's one that sticks in my head. My daughter lives in Japan now after getting out of college, so I'm going to go visit, but I'm excited to see how that's impacting prices. But they have a 24% jump up just, today, starting today. Every Japanese car, motorcycle, everything coming in is 20%, 24% more expensive as of today. It's a straight up shift. And so what that means is people are going to demand less because that price is higher and the prices are higher. So it's a twofold effect. A lot of people, I think, recognize, well, sure, prices went up a little bit. And maybe instead of buying a Japanese car, buying a Toyota, you're going to go buy a GM car instead. And that's terrific. That will increase some demand for US automakers, and it will be good for their profits. There's no denying that. That's terrific. But the immediate impact in the short run is that those car prices go up. People are going to buy less, but the ones that they do buy, they're going to spend more. So it is a price increase. And for that reason, I expect inflation to jump up pretty quickly. There will be factors later as the US ramps up production that will help lower that. And possibly if this lower quantity of items being bought is detrimental to earnings, we could see a little bit of lower inflation because of a slower economy. If we do get a recession, which I think is a distinct possibility, then we might see inflation. That would be a factor of inflation to go down. But this immediate impact that when the Bureau of Labor Statistics goes out and they collect their basket of a few thousand goods and they buy those, these prices are going to go up on some things immediately. Some things will take a couple months. So I took a look at cars. A Tesla Model 3 is built 87% of US components, but 13% comes from overseas. So wherever they're buying those from, say it's Japan or Mexico, they're going to have a tariff. So the price of even a US assembled vehicle has to go up a little bit. I took a look at a Chevy Camaro. The one I saw had 67% made in the US, but 33% was made abroad. So even with these replacements of items, we expect that some of those goods are going to go up, way less. So if a Camaro is 33% made outside the US, maybe the average tariff there is 20%. That's a 6% increase in the cost to make that Camaro. And some people would say, well, the companies will absorb that. And that is just not true. That is mathematically not possible that the companies can absorb that. A lot of these companies have, I'm going to come back to profit margins. If you've got a 10% profit margin where you sell a $60,000 car and it costs $55,000 to build, roughly, I know it's not exactly 10%, but if your prices go up on 33% of the goods by 6%, a total 6%, you can't absorb that whole margin. So the prices will go up. They won't go up by the whole amount, but they'll go up by a significant portion. So, for me, this is very interesting as an economist. I love analyzing these things and, trying to judge, okay, what is the full long-term impact of tariffs? Is President Trump right that we're going to get so much shifting of demand into the US goods that the increased earnings from the US companies will offset some of these increases in prices of some of the foreign goods, and it'll be just better for us overall, and that maybe US markets are making a mistake. At the end of the day, I disagree. I think that there is a drag. The way global trade works is we buy items overseas where they have a competitive advantage and they can make it less expensively. So if it was cheaper for those things to be made in the US, they would have already been made in the US. So the things are going to shift to the US will be slightly harder to make and more expensive. To me, that's okay. There's another reason to do that for defense reasons, a lot of reasons to do it. But at the end of the day, I think the market is justified to drop a little bit, but it might be slightly overdone. When I meet with friends and family, so I do some advice work for friends and family also on the weekends for sure. I'm sure, you advisors do also. I And I talk about these pullbacks. I break out this same exact analysis every time there's a pullback to try to judge when people say, okay, is it a good time to buy yet? This is a very, very rudimentary one, but it's one that almost all the people I work with can understand. This is a 5-year chart, and you can get the same thing off Yahoo Finance or Morningstar.com. They'll all just pull up a quick 5-year chart. And this is the S&P 500 closing price. And what I do is talk about, okay, we've had a pullback. So on the far right, clearly, in Feb 19, we hit our peak, 61.44, and it's dropped since then. We talked about that 17 or 18%. But is it a good price today? How do you evaluate that? The first thing I do is talk about how far we've dropped. So I calculate that in time. So we've gone back to April of last year. So we've kind of given up some returns, and that's okay. The market goes up 3 out of every 4 years. It goes down 1 out of 4. That's for stock markets. That's the S&P going back 100 years. Mathematically, I think roughly 26% of years are negative, but 74 are positive. We might have a negative year this year. 2018 was a negative year. 2022 was a negative year. This one would be a year early, but they don't follow a perfect cycle like you would. That would be nice if you could predict it and get out of markets ahead of time. But we've lost a year of price return. Now, the analysis that I do is I draw a straight line when people really want to know, do you think the market is cheap or expensive? I in my college training, I've got an MBA from University of Chicago. We learned 8,000 ways to evaluate stock valuations. But for me, one of the most simple that I share with people is just drawing this line, a straight line. And I say, you know what? Stocks follow a random walk. And there's a real nice book about that. But if you draw a straight line, they grow roughly 11% total. And for you detail-minded people, that 11% is total return. So 2% of that is dividend, 9% is price growth. So this is roughly a 9% price growth line. And also for the real math nerds, in the real world, a geometric line, it would have a slight curve to it. I know the straight line is imperfect, but let's just, for a 5-year period, that doesn't matter. But what it shows me is sometimes stocks get expensive and they come back, then they get expensive and they come back, and we might be at a reasonable point to buy. Like I said, there are a lot more, I know you guys know this, but, advanced ways to evaluate whether the market's cheap or expensive. But this is one I think a lot of people understand, and it just calms people down to say, yeah, the market pulled back. There's no way to predict when the peak is. So if advisors say, or if our clients say, well, why didn't you get me out at the peak? There's no way to know when it's the peak. Sometimes you'll get a false peak. If you had pulled out at this point in 2024, you would have missed out on this big run. So there's no way to time that perfectly. So, I'm a long-term investor. I'm a fan of long-term diversification. We do make some mild tilts in our portfolios when we really see some fat pitches. But, when stock returns are so hard to predict like that. If you pull out sometimes and don't get back in at the right time, you can miss the subsequent run up forever. So if you had pulled back at this point in July of 2023, and if you hadn't quite gotten back in, the market will probably never get to this low level again. Well, knock on wood. It may, but you might never get in again. And to me, that's the biggest mistake investors make is they try to time the market, they get out, and they never get back in. Finally, the market goes up 400, goes up 400 more, and they can't take the pain anymore, and they relent. And that's a permanent loss of return that you'll never get back, because the market never goes back to the low levels. History tells us. So, I like this line. If this is something you'd like to show your clients, I use paintbrush. I just grab a picture of the most current stock price return. I then draw that line. But I can make these slides available to the Conscious team if you would like to borrow any of these slides and share them with people. I have just a couple more slides. This one I'm excited about, high yield credit spreads. So among bonds, because I've been talking about stocks a lot, I wanted to talk about bonds. I mentioned we cut our high yield in half. So some of you are probably familiar with high yield credit spreads, but what it does is it tells you how much extra return above treasuries are you earning by investing in high yield stocks. So an average on this chart is probably 4. On average, if a treasury bond with a 10-year maturity pays you 4%, on average, you earn about 8 from high yield because you add those two together and you earn the extra spread because they're risky. Occasionally, high yield bonds pull back and have really bad years. Some high yield bonds will go bankrupt once in a while. So high yield bonds go bankrupt much more often than investment grade bonds. So, you're getting compensated this extra money to buy them. But over time, when you see credit spreads shrink, what that tells you is people are really confident. Whoa, high yield bonds are doing great. I'm going to buy them. So the prices for high yield bonds are going up and up and up, and they have fixed coupons. So that means the yields are going down. And so when this yield gets below 3, which it had really never done for this measured history. I get this chart from the Federal Reserve of St. Louis. They produce a lot of free data. I love their data. But when this got below 3, I started really saying, wow, what's going on? And when you run history, if you lower your high yield allocation during these periods, what inevitably happens is eventually there's, something goes wrong and prices for those bonds drop, and you don't want to be in those bonds during that period. So if you get out of high yield bonds, typically, historically, when they're under 3% credit spread, and stay there until the spreads widen, you typically do well. And so that really did happen. We had no expectation that they would spike like this, but over the last couple of weeks, we've seen high yield credit spreads spike, where people are getting concerned about defaults. So, it's a little bit late to get out now, probably. Spreads are above 4. But I included this analysis in here just to talk about that. So if you've got investors who maybe are saying, wow, my high yield bonds kind of did poorly over the last week or two. The reverse is true of what I said. When high yield spreads are high, that's when you want to overweight high yield bonds. So I don't know that the time is now, because sometimes with these runs, if you do get a recession, and this gray area is a recession, you'll see high yield bond prices drop a lot more. I don't know that we're going to get that, but I don't think now is the time to sell high yield bonds is my takeaway. So by leaning on this chart, by leaning on this valuation metric, we're not going to be selling more high yield. In fact, I'm waiting for the moment to get back in. I'm not ready to do it yet. I think there are a lot of reasons to still be concerned about things, but that's my high yield chart. The last one I have is just 2 charts about inflation and tips. So I mentioned we overweighted tips, the Treasury inflation protected securities. We only get inflation data monthly. So we're going to get it in probably a couple days. The last time we got it was March 12 that I saw. Came in at 22 basis points for the month. So this is an annual rolling inflation number for the last 10 years. And we saw with COVID, inflation went way up, came back down. This was after COVID, but it came back down and it's still a little bit elevated, but I expect inflation to pop up again with tariffs. I expect it to be sharp. I expect it to be quick. And that's the reason we are constructive on tips. The last slide I have for you today is a tips break even. So I, again, went to the St. Louis Fred database, pulled for the last 10 years. The tips break even inflation rate tells you whether tips are expensive or cheap. Right now, they're relatively normal priced. This standard range where people expect inflation around 2.5%, what happens is if regular treasuries are paying 4.5%, tips will pay 2 as a coupon because each year their principal gets adjusted up by inflation. If inflation turns out to be 3 or 4% in this year, then you are going to add extra value to your client portfolios by buying tips today. So we're overweight tips based on this. It's what we're doing in our portfolios, but we haven't seen tips prices go up yet because of that expectation of high inflation from tariffs. So, looking forward, we have a value overweight in our portfolios. We have an international equity underweight. We have a small cap overweight, a slight one. We're neutral to emerging market equities. We have a high yield bond underweight, and we have a tips overweight. So I'm going to wrap it up there. And my compliance people say I have to show this disclosure slide for a couple seconds. And I am going to turn it back over to Conscious. So thank you very much for your time, and I look forward to answering questions.
Ryan, thank you so much. It's just such an amazing opportunity to listen to you and to really understand the sort of depth and the core of the fundamental analysis you're doing. And I think it's really great for all of us to get back to basics, right? It's really easy, I think, to get lost in the headlines sometimes, and a lot of the political machinations that we're seeing that are reflected, and we sort of lose track sometimes of the fundamentals. And so, the first question that I'd really like to ask, and I'm sure like you, like I've been in touch with a lot of clients over the last week. We have a lot of people who are concerned, and the number one message I'm sharing is the same as you're sharing, which is number one, like don't overreact, right? Number two, like let's just take a look at the basics and understand that where we are. One of the things that I'm hearing a lot from clients is, and maybe I'm interpreting this a little bit, but they're really concerned about the uncertainty, right? Just the lack of clarity in the policy that we're hearing from the administration right now. One of the things that I've seen in my analysis has been, a reduction in consumer sentiment and a reduction in business owner and CEO sentiment. Can you talk and sort of quantify a little bit the impact of just the uncertainty in the market and how you look at that from an economic perspective?
I'm sorry, it broke up for just a second. The uncertainty on which part?
The uncertainty on the policy, on like how much tariffs,
yes.
how much
So,
they might pull them back, and
yeah, and tariffs could go away overnight. If the administration decided, they could pull tariffs back immediately. My trading team was trading on Monday, and we saw stock markets were way down Monday. But there was a period early in the morning where they spiked up, and the S&P was up 4%. So the market was down 2, and it jumped up, so it was up. And we were like, whoa, what just happened? Why did the market jump? We Googled, we found out 10 minutes later there was a false rumor that tariffs might be put on hold 90 days. And then markets fell right back down. But what that gave us was evidence that if tariffs were to go away, the markets would jump right back up. So, when tariffs do go away, and they will eventually, even if it is in 3 years from today when we get a different administration, it could be. But, we're long-term investors. Markets will come back up. None of this is doing any permanent changes to the market. It is temporary. And hopefully the negotiating tactics work and the tariffs can be taken off. And when they are taken off, we expect markets to jump back up. So I really am recommending that people don't take money out of the market because of that factor. If you miss those big up days, it can be disastrous, to your long-term return. It can shave off, instead of earning 11% average on S&P over 100, you might shave off a few percent over the long run by making those wrong moves. So it could go away. We expect it will go away eventually, but in the long run, tariffs can be a good thing for the market also.
Right. When you look at the extent of the policy and just to state the thing, just to restate what we've been hearing from the administration, right? We're reducing government spending, right? We're reducing government employment. We've got, at least temporarily consumer and business confidence down plus tariffs, right? Does that look like to you that it adds up to something resembling a recession? Like, what's your actual outlook? And I know it's hard to look forward and there are too many variables. So we'll take you off the hook from the compliance team for a second and ask you.
There are a lot of variables. To be honest, my base case is for a technical recession. If we get to inflation, I think GDP will go up in nominal dollars, so regular spending dollars. I expect if we get some inflation, the way that the eggheads in Washington evaluate a recession, and I call them that because I consider myself an egghead also, but they adjust and they try to calculate a real growth number. And so when you get inflation of 3, 4, 5, 6%, they shave that off of the actual nominal growth. And they say, okay, real growth might have been negative for 2 quarters in a row. My base case is that we get a technical recession, but that you don't want to get out of stock markets, because if we do get some inflation, stocks are a great inflation hedge. So stocks will charge more for those products. Stock prices, I believe, will continue going up. So even if we get a technical recession, I'm not getting out of stocks in this case because I expect there might be some inflation, and those stocks give me a very reasonable inflation hedge.
Yeah, that makes sense. Last question. I know that we need to let you go here in just a minute, but when you were looking for the key signals and the key indicators, what are the signals that are going to tell you that things are going to start to get better? Are there a couple things that you're looking for in your analysis?
So much of this drawback is simply tariffs. But what I'm going to watch is earnings. Earnings for multinational companies, earnings for U.S. companies. I want to see that if there is a very short-term earnings drop. So we're going to get earnings in July for second quarter, and I expect earnings are going to go down, and the market is pre-baking that in. That's what the market does. It bakes those things in, but it's all about expectations. People expect earnings to go down for, that candle perfume, a friend of mine and his corporation, they expect it to go down. So the market has already shaved off 18%. I suspect that is enough. I suspect that does the job, that accounts for all that earnings loss. So what I'm going to look at is expectations of those returns versus what the market has already discounted. And, I am I'm positive on markets from that point of view.
Great. Brian, we want to make sure we let you go on time, so thank you so much. I'm going to ask Lawrence to join us, and we're going to talk a little bit about how conscious capital is taking all these things and applying it to client portfolios. Brian, as always, it's just an absolute sincere pleasure to spend time with you. I know you get to go do this call again here in just a few minutes. I'll just kind of laugh by saying it and use this as a little bit of a transition. I was on a webinar similar to this morning, and the analyst said, don't trust anyone who looks like they're well rested.
I've got some bags under my eyes.
So just want to humanize the side of it, and really grateful for all the work that you're doing on our behalf and on behalf of our clients. Thank you so much.
Thank you. Thrilled to be here. I look forward to doing it again anytime. Thank you.
Take care, Brian. Be well now.
All right.
Oh, Lawrence, you're muted. Come on back.
Excellent. Thank you. I was saying thank you to Brian, and I know for our clients, it's a real treat to be able to have him be a part of our team as an economist and as a part of a deep part of our team as we construct the portfolios. Greg, I think just to tie this back in towards the end of this, what I'd like to make clear to all of our clients on today and those who will be listening later is, as all of you are well aware, because we were in touch with you, we've been making, a lot of adjustments early in the year, towards the end of the year and early into the year. Not trying to time markets. That's dangerous. It doesn't work. You heard Brian. But really to have you well positioned for the long run as we go forward, because there are a lot of great long-term opportunities. This short term is just not fun.
Yeah, it's an interesting thought too. And Lawrence, as you and I have been talking, for the many years that we've worked together, but especially this year, we really talk about, how do we walk the middle way, right? And how do we navigate this integration of, watching the headlines, watching the news cycles, watching the volatility in the markets. I mean, for people who are paying very little attention, right, they're seeing, crazy swings, even intraday, like much less like these big changes we've seen. For those paying a little more attention, they notice we've had a lot of volatility in bond prices just in the last couple of days. So it's easy to get swept away by those things. And I think that one of the things that I love about our firm is the way in which we kind of balance our outlook, right? That we think about, okay, there are things that are fundamentally changing, but at the same time, the sky probably isn't actually falling. And so would you just kind of like bring that forward in our philosophy and talk a little bit about how we systematically look at things? And then I think we'll move into a little bit about some of the adjustments that we made in portfolios.
Yeah. I think what we should do, Greg, if we can, is just do a little, because I see a lot of our clients are still here. Thank you for hanging in. And by the way, just as a note, we, as you all know, we really treat you as part of the family. And as such, we want to talk to you, not down talk to you. So when we bring Brian on like this, there's clearly we geek out a little bit with you, and we appreciate you hanging out for that, because there's different varieties of the appetite for that level of detail and left brain. But it's important that we are always here as a firm to continue to empower you, which really gets to where I'm going with this. Before, I think we should see some of the questions coming in here too, Greg. The one comment I would make, and it's, stating the obvious here, is that, first of all, I have been doing this for over 30 years now. I can't believe I'm saying that. So we've seen a lot of stuff. And the most dangerous thing in our business is to always say, but it's different this time. And that's an old saying in our business, which gets people in a lot of trouble when they think it's different this time. But there is something that's unique about this time, and it is the division in our country and around the world today. So you add not only a sharp decline in the stock market, which hurts everybody emotionally because, they're looking at their values temporarily going down. But then you add on top of the divisiveness of, depending on which side you're on, and that adds a lot of emotional fuel. So I just want to call that out to everybody and make sure that, first of all, thank many of you, because we watch this with the numbers, many numbers of our clients and offices. But we've been watching the fact that you are actually listening to us as advisors and the different offices, which is really important, because it's a time we're here for you to give you perspective. And we know a lot of you have been highly emotional through this process. And I just want to thank you for the discipline, listening to us as the discipline that what we structure, Greg, in our models and our portfolios, of which you asked me, which is really defining certain kind of buckets of like, what is the money for? Getting very fundamental. Is this a 1 to 3 year? Is this a 3 to 7 year, or a 7+? Obviously, each one of those needs to be more conservative depending on how short you're going to be using that money. So we're intentionally investing in those buckets, as we call them, for you. And then within those buckets, we have a very sophisticated platform, which is really fabulous. I mean, it's candidly something if I had it 20 years ago, or even 10 years ago, or even 5 years ago, I would have been thrilled. And we've worked very hard to build this technology platform for you, where we're individually investing in stocks for you in our models that are highly diversified. So, technically, we are using separately managed accounts, which then are in structured products that are built for different things, whether they're defensive, whether they're gas on aggressive, that's 7 year plus, with a heavy tilt into artificial intelligence related companies, for example, that are going to have a huge lift going forward. And then the ultra conservative models, where we're really doing a lot in money markets as well as dividend gaining stocks, which are kicking out, regardless of what the stock does today, somewhere around an 8% blend dividend, which means regardless of what the stock does, you're getting an 8% return if that continues. So, and structured notes and all sorts of protection vehicles that we've been building along. And so very, very proud of that. Very proud of our different offices that are managing that so well, and all of our expanded team.
Yeah, and I just want to thanks for bringing that up, because I really wanted to name, that the answer for an individual client, lies in working directly with your advisor, right? And Tom McAuliffe from the Bay Area on our team, as well as Mike Mancusi from Westport, Connecticut. We've got a great geographic distribution. We've got different worldviews and outlooks. And so we've got a really nice, diverse team for people. Be sure to reach out to your advisor and find out kind of what's right for you, right? And each person's circumstance truly is different. What we do, I think, and what we've been doing really well, is having a really big suite of options for people, right? Everything from the most conservative in money markets, into traditional bond allocations, into then credit. We've had, like, as you mentioned, this great credit program. And, we built and added a whole defensive suite of portfolios in the pot for the possibility that we move to, a much more challenging economic year this year. Then, of course, as we've talked about before on these calls, we've got great products in the governance suite, the G suite, right, where we're really focusing on best run companies. And then as we move into even more aggressive opportunities, as you mentioned, again, the concentration in AI and robotics, and inclusion of Bitcoin, which is a whole separate conversation. We're not going to start the conversation.
And I think the private markets, Craig, you can mention as well, which is great non-correlated or very lightly correlated option for our clients that had been paying 14% per year, paid out quarterly for 2 years, and you get your money back while you're helping emerging entrepreneurs around the world. So it's really, we're very
it's really compelling work. And so as a result of those tools, we get to really build the portfolio that's right for each client. And I think that, while we don't talk about broad returns, because our returns are customized for each client and what their needs are, like, broadly speaking, I'm seeing that our portfolios are holding up pretty well through this time. And so for more details on that, please do reach out to us and learn more about how we can build the right portfolio for you, and if you want to make any changes.
And as we wrap this up, great timing, Heather. Thank you, everybody, for hanging in there the whole time. Stick with us for one more minute, because Heather, if you could talk about, we do on a regular basis now, we're doing quarterly calls like this with our clients. This one was an extra we wanted to throw in because of these times. But Heather, if you could talk about the next call, how people would be able to sign up. This is a discipline of keeping yourself empowered. We also want to invite you to invite friends if you'd like as well. We leave these open for everybody because we feel everybody really needs to be educated and empowered through these times. So Heather, off to you.
Perfect. Thank you so much, Lawrence. Let me share my screen. Our next quarterly call is coming up on May 6th at 5 p.m. Eastern, 3 p.m. Mountain Time, and 2 p.m. Pacific Time. But I'm going to put that in chat right now, everyone, but you can locate the last recording of the last call, which was Q1 market updates, conscious capital market updates. And then the next one is May 6th. So you click here and you'll be able to register. I want to thank everyone for taking the time out of their day. I'm also putting in chat as well my contact information and the link to that website. So you can feel free to go ahead and check it out, or give me a call or shoot me an email if I can be of further assistance, or if you have any questions or comments. I want to thank everyone for joining. I know everyone's time is really valuable, and special thanks to Brian Huckstep, who will be joining our next quarterly call on May 6th. And Greg, thank you so much. And Lawrence, thank you.
And
Everyone
before
have
you
a-
go, I'm going to jump in quick just to remind everybody, if it wasn't clear, this call will as well be posted on the website. So you will be able to get this as well and share it with your friends.
Thank you so much, Lawrence. And thank you everyone again. Have an amazing day, and we'll talk soon. You let us know if we can help you, okay? Thank you so much, everyone. Bye-bye.